Hey everyone, I am Prithviraj and along with my teammates Anushka, Samruddhi and Khushi, we are here to present one of the most infamous business failure cases in history, the Enron Corporation scandal. This case study will take you through how a company once celebrated as America's most innovative fell from grace due to corporate greed, accounting fraud and ethical failures. Let's dive into this fascinating yet cautionary tale that forever changed the business world.
Understand how such a highly innovative and respected company collapsed, we'll walk through a clear sequence of events. We'll start with a brief introduction and company overview, then dive into the business model and rapid growth that masked the fraud. Crucially, we'll examine the toxic corporate culture and leadership that enabled the deceit, the specific causes of collapse, like off balance sheet entities, and the audit and regulatory failures. Finally, we will conclude with a timeline of the scandal and the lasting impact and consequences on the business world. Let's set the stage. Enron Corporation was a major American energy company that by the year 2000 employed over 20,000 people and claimed revenues of nearly $101 billion. It was frequently recognized as one of America's most innovative companies. However, in 2001, Enron completely collapsed due to one of the largest accounting frauds in history. This was a systemic failure of corporate corruption. The scale of the deceit was so vast that it didn't just bring down the company, it triggered significant regulatory changes across the entire financial market. The most notable outcome was the creation and enactment of the Sarbanes-Oxley Act of 2002, a law designed to restore investor confidence and improve corporate governance.
So, what exactly happened with Enron? In the 1990s, Enron transformed itself from a simple natural gas pipeline company into a global powerhouse in energy trading and innovative markets. Sounds impressive, right? Well, here's the catch: their remarkable growth was actually built on a house of cards. Behind the scenes, they used risky accounting practices like off balance sheet entities and mark to market accounting to hide massive losses. This pursuit of profit at any cost led to their bankruptcy in 2001, wiping out billions in shareholder value and devastating thousands of employees. Let's start from the beginning. Enron was founded in 1985 when Houston Natural Gas merged with Internorth, finally focused on natural gas pipelines. They quickly expanded into electricity, communications, and global commodities trading. By 2000, they were a giant, over 20,000 employees, and nearly $101 billion in claimed revenues. They were even recognized as one of America's most innovative companies. But this aggressive expansion and complex financial maneuvering set the stage for what would become their downfall.
Enron's business model was initially built on solid ground, natural gas pipelines, and coal transportation. But it rapidly evolved to become a complex and multifaceted giant, adding energy trading, commodities trading, and financial services. The heart of their innovation was the natural gas bank model. This model leveraged financial instruments and long term contracts to manage supply and demand, which was a brilliant concept for boosting profits through financial innovation. However, it was their highly sophisticated financial manipulation techniques that led to deception. Enron executives masterfully used mark to market accounting, a highly aggressive method to immediately record projected profits on long term contracts, which effectively allowed them to inflate their reported profits and revenue. This combined with the use of off balance sheet entities to hide massive debt created the illusion of a highly profitable and stable company. Ultimately, this unsustainable house of cards was exposed, leading to the outcome of collapse and bankruptcy. Enron's growth trajectory in 1990s was truly explosive. Formed in 1985, by the early 90s, it had transitioned from being just a natural gas producer to the largest seller of natural gas in North America. A key and ultimately disastrous moment came in 1992 when they began aggressively using mark to market accounting to report their fast growing profits. They continued to expand, moving into electricity markets following deregulation in the mid 90s, and by the late 1990s, they launched Enron Online. This platform became the largest e trading site globally for commodities, solidifying their dominance in financial trading, not just energy production, which is where majority of their purported income would come from.
Now let's talk about what was happening inside the company. Enron's culture was extremely aggressive, competitive, and obsessed with short term profits. CEO Jeff Skilling promoted a win at all costs mindset that encouraged creative accounting and rule bending. They had this brutal system where employees were ranked binary and the lowest performers were often fired to maintain pressure. The company rewarded deal making and stock price growth over transparency and ethics. Founder Ken Lay, while charismatic, allowed these unethical practices to flourish. This toxic environment created secrecy, internal rivalry, and ultimately led to the ethical collapse. So, what exactly caused this giant to fall? First, they used fraudulent mark to market accounting to inflate profits artificially. They created off balance sheet entities, essential shell companies, to hide billions in debt and losses. Corporate governance was practically non existent, with the broad failing to provide proper oversight. Their leadership was unethical and greedy, prioritizing stock prices over honesty. Here's something shocking: the external auditor, Arthur Anderson, was actually complicit in covering up the fraud. Add to this incentive structures that encourage risky behavior, lack of regularity oversight in the deregulated energy market, and a culture of secrecy that suppressed whistleblowers.
The Enron scandal highlights a critical failure of the checks and balances designed to protect the public. Arthur Anderson, Enron's external auditor, was complicit. They failed completely to provide independent oversight and ignored major accounting red flags. This failure was fueled by a severe conflict of interest. Anderson was earning lucrative consulting fees from Enron, which compromised their audit quality. This led to the dissolution of what was once one of the big five accounting firms. Internally, Enron's board and audit committee lacked the will and the expertise to challenge management's risky and deceptive practices, and internal controls were weak. On the regulatory front, bodies like the SEC were too slow and ultimately failed to detect or act on the complex financial manipulations. These failures collectively enabled the executives to hide billions in losses, which you can clearly see reflected in the company's stock price chart. After a massive peak, the value collapsed, wiping out all investor confidence and leading directly to Sarbanes-Oxley Act to improve future corporate oversight. Looking at the timeline, the seeds of the scandal were sown early. Enron was formed in 1985. In 1992, they received approval for mark to market accounting, which gave them the tool to record projected profits immediately. By early 2001, Enron was at the height of its market dominance, but the questions about its earnings and transparency were growing among analysts. The final descent was incredibly fast. In August 2001, CEO Jeff Skilling abruptly resigned. Then on October 16th, Enron announced a massive $618 million quarterly loss and a $1.01 billion reduction in shareholder equity, the first major admission of financial trouble. Just 2 months later, in December 2001, Enron filed for Chapter 11 bankruptcy. Billions in value vanished virtually overnight, marking the beginning of the legal and regulatory fallout.
The unraveling happened quickly. In October 2001, the SEC began a formal investigation into Enron's finances, and the company acknowledged scrutiny over conflicts of interest. By November 8th to 28th, Enron revised its financial statements, revealed massive losses, and entered bankruptcy negotiations. December 2nd, 2001, Enron filed for Chapter 11, which was the largest bankruptcy in US history at that time. In early 2002, Arthur Anderson was found guilty of destroying documents, and Enron executives were investigated and testified before Congress. The aftermath led to the Sarbanes-Oxley Act to reform corporate accountability. The consequences were absolutely devastating. Investors lost around $74 billion when Enron collapsed. Imagine that kind of financial destruction. Enron employees lost billions in pensions and retirement funds as the savings evaporated overnight. Over 25,000 employees lost their jobs, creating significant personal and community hardship across multiple cities. The scandal destroyed the careers and reputation of Enron executives, with several facing indictments and prison sentences. And remember Arthur Anderson, the auditor? The firm completely collapsed, leading to a sharp decline in trust in corporate financial statements across the entire business world. But the impact went far beyond Enron itself. The scandal triggered a sharp drop in market confidence, making it slightly harder for companies to raise capital and go public. This crisis directly led to Sarbanes-Oxley Act in 2002, which enforced much stricter corporate governance, financial reporting, and auditing standards. Energy markets actually slowed that deregulation efforts as new accounting procedures and compliance requirements were implemented, increasing costs for all companies. Most importantly, it raised public awareness about corporate fraud and sparked increased regulatory oversight of major corporations. Enron became the textbook example of what when ethics happen when ethics are abundant for profits. Thank you.